All right, welcome everybody. I'm Brian Briscoe, host of this event. Now, incidentally, this event is, I think, co-branded or not it's listed on a couple of places on the Meetup app. It's the Gaithersburg Apartment Building Investing Group, because I started that when I was living in Gaithersburg, just haven't changed the name. It's also on Tribe of Titans. I put this in a lot of different forums, but wherever you heard about it, wherever you're coming from, welcome. And if you're watching this, a day or two after when it's up on YouTube, even better. But welcome to the apartment building investing meetup. I think we call it multifamily mastery in other forms too. So whatever it's called, doesn't matter. But just real quick, I'm going to introduce our speaker. But I'll say, before I do, I'll say this, but I was the guy for the longest time that did my own taxes, right? And I went to, different tax courses. I did like the volunteer income tax assistant course the IRS puts on. It was a week-long thing. I took community college classes in like tax preparation and everything else. And absolutely fascinated by the subject, not really because taxes are fascinating, but because saving money and paying less is fascinating, right? And learning how the tax system is set up, and that you could actually set up your income and investments and everything else to take advantage of it was absolutely fascinating. So I thought I knew everything. I've been doing my taxes, every single year ever since. And I've got to say, I have paid zero federal tax over the last 20 years. And this last year was no exception. The difference was, I did my taxes last year on TurboTax like I usually did. And I didn't quite zero them out. And I was really close. And I'm like, you know what? And I'd known Deb for a couple of years, and she's the CFO for Four Oaks. And I know my partners all use her for taxes. And I'll just tell you the power of having a tax professional on your side. I had my number. I sent my, this is what I think I'm getting back by myself. Sent my taxes over to Deb, and I ended up getting $6,000 back in addition to the small refund I thought that I was going to get by myself. So there's definitely a lot of value in hiring tax professionals for what you do. So Deb is not only, not only handles my personal accounting, tax needs, but she also is the CFO for Four Oaks Capital, takes care of us as a company as well, and does a lot of really, really good things for us, and very appreciative. But she's been doing tax planning and preparation for individuals, partnerships, and corporations since 2000. So, a full, 20 years and maybe some change. Her expertise includes a wide range of tax issues, including real estate partnerships, nonprofits, and international taxation. And just point out the international taxation bit. She's lived in a couple of places internationally, so something that she's well-versed at. And currently works at McCarthy, Rose, and Mills, a Dallas-based accounting firm. And incidentally, where did I put it? I just got a little gift from this. Here it is, right here. Oh. So Deb, I don't know if you had anything to do with that, or that just automatically came, but that came from MRM today.
We definitely pick out who we send those to.
All right.
That's our Christmas picture in Texas. We should have had Santa hats on or something, but it's been.
Yeah, I mean, you all have scarves on, and it doesn't look like scarf weather, but I guess when it gets down to 75 in Texas, everyone's like, oh my goodness. Yeah, not really though. But that said, Deb, thank you for doing this for us. Thanks for taking an hour of your time and talking, taxes and finances with us.
Mm-hmm. Well, so the only reason I've been only doing taxes in the U.S. since 2000 is because I only got my work permit in the end of 1999. Because originally I came here on an H-1B visa with my husband. But in 2008, we got citizenship. So because you get treated just like a U.S. resident if you're going to leave, if you've had a green card 8 to 15 years. So I figured I want to be able to vote.
Yeah.
you can do everything, pay taxes, but they won't let you vote. So,
Mhm.
but yeah, we're going to talk a bit about, I think Brian said, like real estate, passive investing, active investing. But
Yep.
if you don't do any tax planning, I always loved this quote by Bill Murray. He said, the best way to teach your kids about taxes is to eat 30% of their ice cream. And if you don't do tax planning, you could end up paying, 30% or more,
Yeah.
in taxes.
What I did for our kids, and for a while I was doing this every Halloween. I can't eat candy very much anymore, but when the kids would come home with their big bags of treats, and I was still in my 20s, it'd be like, all right, here comes the dad tax. I'd pick through their candy and dad tax it up. But yeah, I mean, it's crazy. Like I don't remember what the exact tax brackets are. I know the highest US tax bracket for income tax is in the 30s. And if you're living in states like California, I think they have like the 12% tax bracket plus, your payroll taxes. And I mean, it adds up really, really quickly. But as I mentioned in the intro, one thing that helped me realize the benefit of real estate investing was how well IRS treated your real estate investments, and that's part of the reason I've been able to zero out my taxes, at least for the last 15, 20 years. But, before we get into the tax issue, Deb, do you want to give everybody a little more of a history, who you are, and, what made you, among many things, go into taxes?
So basically, when I graduated from university, I went to work for Amoco, which is now BP Amoco. So I went to work for Amoco up in Canada, worked on their special projects and stuff. But then my husband worked for Nortown. And so, we traveled around the country in Canada. Then we moved to the UK, we moved to the Netherlands, we moved back to Canada for a bit, and then came to the US in '94. And so when I was looking to see what I could do, and so I filed our taxes in all those countries. Now, the Netherlands was the most challenging because I couldn't actually read the forms. So I did actually have somebody help me with the translation and stuff like that. And all the big four firms are over there and you can get them. But I always wanted to understand how it worked. And they were always much easier to understand until we came to the US. The US tax code is overwhelming. So we actually had moved around several times in the US. And, a CPA can only really practice in the state they're licensed is. There is some reciprocity. But so I took all the enrolled agent exams, and it allows me to practice tax in all 50 states.
Nice.
And basically all of my CPE has to be in tax. I can't take any fluff courses. It all has to be tax related. So most of the classes I take are in real estate. And I've taken 3 classes on Section 1061, the carried interest rules this year, because that is a hot topic right now. We've taken classes on the 163J, like why we make the business interest, trader business election and stuff, because we want to take advantage of the tax code. We want, everyone to be able to use the tax code to their advantage. And real estate has lots of tax advantages. So it was the one thing, so because it was so complicated in the US, I decided I needed to know, and actually I love it. I mean, all of that, saving taxes. Unfortunately, my husband and I were both basically W-2 partnership income. It's really hard to save taxes when you have 2 people working full-time jobs. If we can get one of us, I keep trying to convince him he needs to give his up and become a real estate professional, because then you start saving. Saving money. You only need one of you to be a real estate professional to reap the benefits.
Yeah, absolutely. And I'm excited. This is my first year qualifying as a real estate professional. So it's going to, I don't think I'll ever pay taxes again, to be honest with. Well, I mean, tax law changes every year, and I'm sure, they tend to be closing up a lot of these so-called loopholes, every single year. But tax planning, it's a big business because it can save people a lot of money. And incidentally, like I started out saying that, I paid a small sum to get a large sum back through Deb and MRM. So, it's a big business because it can potentially save people a lot. Now, Deb, you also passively invest in real estate too, right?
Right. Yeah, I've been passively investing since 2008.
Mhm.
So I've learned a lot from passively investing. Like some of the people that I invest with, I've become very picky at who I invest with, because actually one of the LLCs I was in, and I've
Mhm.
often just invested just in my personal name or in maybe a self-directed IRA, now a qualified retirement plan. But the one investment that I was in about 2010, we removed our general partner from his position because he was commingling funds and things like that. So we removed him. He turned around and sued the LLC and sued every investor in that LLC personally. So he lost, and we used his money in the deal to pay for the attorney. So it showed me that the LLC protected us, but it was still a 2-year, pain in the butt kind of ordeal. We would get these. I just made a rule: if an email came from him, it went to a folder. I didn't even look at them because we'd get these nasty, threatening emails saying he was going to take us down and stuff.
Mhm.
But you are well protected by the LLC.
Yeah.
And so.
Yeah.
So at the beginning of the year, I was in 9 deals, 5 have sold. I've redeployed my funds from 4 of them, but I just had a deal that closed December 3rd. And I will need to redeploy that income before December 3rd so that I don't pay any taxes. Because
Yeah.
the whole name of the game for me is I don't want to pay any taxes on my passive income.
Absolutely. Now, before we talk about the, how to offset your gains and whatnot, let's talk about the rules in place that make real estate friendly. For example, can you go into why real estate is very friendly when, the IRS is concerned?
Yeah. And actually, this only happens in the country, in the U.S. Every other country allows you to depreciate something, but it's not going to let you depreciate it below. It's not going to let you take your income below 0. But in the U.S., we can take our income well below 0, and we actually are allowed to depreciate an asset that's actually appreciating.
Mhm.
So that's why we really encourage cost segregation, because
Mhm.
even though as a GP, you may not need all that depreciation, you have no idea what your passive LP investors need.
Yeah.
If they've got deals that have sold this year, they're going to need as much depreciation as they can to offset their passive gains.
Yeah.
So,
And can you
all
explain
property. Go
can you
ahead.
explain the concept of depreciation? I'm assuming most people understand it, but in case there's one or two that don't know what depreciation is.
Right. So depreciation, we take asset classes. We take a building, 27.5 years. We'll take furniture and fixtures. That's usually a 5-year class asset. Land improvements like the parking lot, maybe a playground. Those are 15-year assets. And then you have your land, which is never depreciable. And so the IRS lets us take, 1/27.5 each year until we have fully depreciated that asset. What a cost segregation study does is typically it's done when you buy, and it can be done later as well, but it's typically done when you buy it, and it takes the purchase price and it allocates it into those asset classes. Because typically if you buy it, it's just going to be building and land. They're not going to, the closing statement isn't going to break out your asset classes.
Yep.
So, and then with all the tax changes in 2017, we got the 100% what we call bonus depreciation. So on all
Yep.
assets under 20 years and under, we could actually write off 100% of it in the first year. Now that is the same for 2021. It starts phasing out. It goes down to 80%, then 60%, and it's been at 50% for quite some time. So it really depends what the Biden administration is going to do, but they haven't touched depreciation in the
Yet.
current
Yeah.
proposal. So
Yeah.
But that's what depreciation does, and cost segregation is really just breaking it down into the asset classes. And then
Yeah.
once you
So
take,
go ahead. Keep going.
I would say once you take over the apartment building, as you're doing your rehab, your property management company should be putting it into the asset classes. They should be saying, this is appliances, this is flooring. And your CPA will know that appliances is a 5-year asset class. Flooring is a 5-year asset class. So we break it down and take bonus on it going forward.
Yep. So long story short, I mean, depreciation, paper loss, you get to take advantage of, presumably the value of property, value of assets going down over time. And it's a wonderful thing because even you can be cash positive, getting money from your investments. And then when your tax statement comes in at the end of the year, have a large negative number on it, which I think is amazing. And you mentioned this earlier, Deb, but what's great is if you can't use it all in one year, you get to carry it forward until you can use it. So let's talk about who can use depreciation, where it helps you on your taxes, and then once we get into there, we can also talk about exactly what a real estate professional is. So how you can use the depreciation to offset your income and go from there.
Yeah. So basically, all of us, passive and active, can use all of the same tax benefits of real estate. It is basically just a timing difference. Okay. So as a passive investor, I can only use all those benefits of real estate when I have passive income. And, and passive income for me has only happened when an apartment building is sold. So if they do a refinance or distributions, none of that is ever income. So the only time I've ever had a passive, event is when the actual apartment building is sold. And then all of my passive losses are released to offset that gain. And the thing about real estate losses is they are all ordinary. Okay, so they are still ordinary losses that get released when I have passive income. And so they offset all of my ordinary income for that year, those passive losses. And then, it'll eat up all of my income that's being taxed at 37% and leave maybe just the capital gain, which is getting taxed at 20%. So any that don't get used carry forward to, for the next year.
Yep.
So basically, since 2008, I have not paid any tax on any of my passive real estate investments because as soon as one of them sells, I'm looking for deals to get into so that I get my depreciation, I get my interest, I get all those deductions that come with real estate to offset the gain from if I don't have enough passive losses already. I've been playing the numbers, I look at the numbers to make sure that but also I want to deploy the capital so that it's actually making money.
So, I mean, essentially, returns aside, if you continue to passively invest in, real estate, depreciable assets, so syndications and whatnot, you can continually defer your taxes. So even when the property sells and you get a big chunk of capital gains, if you're taking that money, if you don't have any carried forward passive losses from the year before, you can just take a big chunk of that money, park it into another similar investment, take all that depreciation year one and cancel out all of your gains and essentially keep on kicking that tax bill down the road.
Right. So to put it in like money terms, I have a client that put $200,000 into an account and just decided he would, see what they could do from there. That account is currently sitting at just under 1.5 million, and they paid $0 in taxes. Because basically throughout there was like some refinances. So one of the deals they got refinanced out of twice. They took that money, deployed it into other deals. And there's been no tax paid on anything because it's either been distributions, refinance, or capital gains that were offset by other deals that gave depreciation.
on
So
$1.5 million.
with a $200,000 starting balance. You
Mhm.
can't do that in the stock market.
Yeah.
I mean, I would have to sell something to get the cash to put into something else, but they didn't have to do that in real estate.
Mhm. Wow. That's a good story. Hopefully I can turn 200K into $1.5 million in the next couple of years. We'll
Well,
see about that.
that's from 2013 to 2021.
Yeah. So that's about an 8 times multiple in 7
Yeah.
years. Wow.
Yeah.
Those are some good numbers. Those are some really good numbers.
And those are real life numbers. It's not, and that's passive investing as well. That wasn't active investing, that's passive.
Yeah.
So,
and one thing, I mean, if this was, W-2 income, if you were making the same amount of W-2 income, you'd take a big tax bill, or even investment income, when you pay the taxes, it reduces what you have left over to invest in other things. So if you're trying to sell stock to reinvest it somewhere else, you're going to have your long or your short-term capital gains, which eats into that money that you can reinvest. So it's not just the money that they have right now, but they were able to reinvest 100% of their proceeds every time they did another transaction, instead of paying your 20% capital gains or 15% tax. I don't even know where the capital gains taxes are right now, but instead of paying the capital gains and investing what's left over, you're essentially able to take your entire investment, roll it into something new, and keep on kicking that tax can, like I say, down the road. I like using that phrase. That's
right.
I used to play kick the can a lot when I was a kid.
Well, and even for me, when those passive losses get released, remember they're offsetting my ordinary income, which is with my husband and I, it doesn't take very much to get into the top tax bracket, 35, 37%. And so in those years, we actually pay less tax because the losses offset my ordinary income. And then, I pay tax at a capital gains tax rate instead of that 37. So it really is a timing difference for me. I can't use it on an annual basis every year like a real estate professional, but I can use it every time my passive losses get released.
Yeah. Now let's talk about that specifically. Who can use that? I know there's, and I'm not sure exactly where the IRS draws the line in the sand, but where's the line in the sand drawn between who can offset their active income or their ordinary income with their passive losses? And then the next question, the follow-on question would be, how does that change for real estate professionals?
Okay, so no line, everybody can use passive losses against passive income. They don't draw any line in the sand. It just has to be passive income.
What about active income?
No, you cannot use passive losses against active income. So we have 3 types of income. We have ordinary, portfolio, and passive. You can only use passive losses against passive income. Portfolio is going to be like royalties, interest, dividends, Schedule D, and ordinaries, Schedule C, wages, S Corp income. So you can only offset passive losses with passive income. But active actually changes the nature of the income, that passive income to active, and allows you to write it off against everything. So that's why the IRS has rules in place for what an active real estate professional is. So basically there's 2 tests, one to actually say that you do qualify as a real estate professional, and then there's 7 tests that we go through to make sure that you materially participate. So the first test is you have to work a minimum of 750 hours or more hours than you work at your personal service income job. So that would be your W-2 job. So I have a doctor who is contracted to work 1,600 hours. She gets a W-2, but her contract says she does only work 1,600 hours. We track her real estate hours and she works more at that. So we call her a real estate professional every year.
Nice.
The real estate professional is an annual election. So you have to qualify every year, and she qualifies. And, we just have a log. I mean, the firm has had 2 real estate professional audits. and both were no change audits because we have a log to back up her hours. And
Nice.
so we are never afraid of claiming that status if you have the logbook, to back it up. So I have several people that, kind of work part-time but get a W-2. So they're now going and getting contracts that, that their employers say that they have to work, so many hours so that they can actually claim real estate professional status as well.
So 750 qualifying hours, and you have to work more than your other job, your W-2 job.
Okay. So if you don't have a W-2, you just have to work 750 hours.
Mhm.
Now, if you've got, if we're trying to qualify you in all of your, generally you got to be a GP on the deal, because if you're a passive investor like I am, I don't have anything to do with any of the day-to-day decisions. I don't make any decisions. I don't have any contact with the investors. I couldn't turn that into active, I couldn't say I was active in that. But if you're a general partner, and you've got a job that says, you're reviewing the monthly financials, or you're the one that's corresponding with investors, or you're the one, staying on top of the property management company, then you've got a day-to-day job in that partnership, and we can say that you're active in there.
Okay.
And so,
Now, question from Angel: if you have a W-2 but it's part-time, do you still have to log your hours?
you always have to log your hours for real estate, always. Yeah, because not everything counts, right? And so, you can't give me a log and it says 8 hours. I've had some, say like talk to investors for 8 hours. And I know that you probably did, but that's not going to hold up with the IRS. You're going to have to say, talk to Brian Briscoe 1 hour about investing in the latest Four Oaks deal. Talk to Angel Williams for 75 minutes. You have to tell us who it was and what deal you were talking to them about. Or maybe you had lunch with them. I mean, it's more work, but basically we have a template, and it's by month, it's by day. If you've got that template with you, it's easy to fill out, on the job, or you can put it in your calendar. It's just got to be really, detailed. Because you've always got a calendar on your phone, right?
Yeah. So basically, you log your hours to make sure that you're bulletproof when it comes to audits, but you have to hit that 750 hour hurdle no matter what. And so you log your time so you can be able to prove that you hit that 750 hours if you're working part-time in a different job or not at all. And you have to show that you work more hours than your full-time job if you work full-time.
Yeah, or part-time. And then the other thing is that is on a per project basis. So if Four Oaks has 6 deals, it would be 750 hours for every deal. So what we do when we do your tax return is we make an election to group them all together so that you only have to do 750 hours as a real estate professional. We typically aren't going to group them if you're not a real estate professional, but if you are a real estate professional, we're going to group them because there's no way that, 50, you get to 10 of them, 7,500 hours, it's impossible.
Yeah, there's not that many hours in the year to be able to do that per deal. So, wow, let's see, that's rough math, math in public. I hate doing arithmetic in public. That's about 15 hours a week is what that is, just rough numbers.
That's right. Yeah. So yeah, if you've got a part-time job, Angel, I'm sure that you could be a real estate professional because I know you've been putting a deal together, raising all that stuff. I know how many hours I spend with just talking to, answering questions to, potential investors. Maybe you're getting foreign investors. All of that stuff counts. And sometimes you can be on the phone for 3 hours with some of these people, or, closing a deal. You can be, I've, talked to some of the sellers because they, didn't feel comfortable with how the thing, we walking them through the process takes hours. So it's easy to get to 750 hours.
Yeah, it's even if it's a side hustle, it's easy to get to the 750. The hard part is if you're working full time is to do more than your other job.
Yeah, because if you don't have a contract and you're a full-time employee, the IRS is going to say that's 2,080 hours.
Mhm.
And they're not going to budge from that, because that is the norm in the, and so you'd have to work 2,081 at real estate.
All
And
right.
that's hard to get to.
Okay, and that might answer Angel's question. She said, my husband's moving from a W-2 to a consulting 1099 position. Should he get a contract specifying the number of hours?
Yes, yeah.
Yep.
Yeah, I mean, somebody else on this forum I talked to, he's, he does coffee shops. He's a W-2. He said he definitely works more hours at real estate than he does at the coffee shop. He actually gets them set up, gets them running. So he's going to get his employer to give him a contract that says, how many hours he works, so that he can prove he's a real estate professional.
Okay. Now, if you're getting an hourly wage, can you just take all of your pay stubs and add them all up? Do you need the contract? I mean, like if you're working part-time for Denny's or whatever.
No, because we'd have how many hours you worked, right?
Yeah.
Yeah.
Okay.
Yeah. And then so if you're just hourly, not salaried, we don't need that.
Yeah. Well, in the case of my previous profession, I think the was 2,080 hours is actually a lot less than I worked most weeks. So I take that as opposed to documenting everything and getting the contract. But all right. So a couple other questions. So we talked about, depreciation, tax advantages. We talked about some strategies to keep on deferring the taxes, and that's, basically you make sure that you're offsetting your capital gains with more depreciation. You're carrying forward depreciation. And actually, one question that's somewhat related, Mike asked, he's talking specifically about that example from 200K to 1.5 million. He asked if there's any 1031 exchanges built into that.
No, and I was just going to bring that up. No, There's no 1031 exchanges. And if we can actually offset our gains through getting into another deal where they're going to provide, if there's enough depreciation and other deductions, I stay away from 1031s, because there's a lot of rules, a lot of regulations, carryover basis. So if I can stay away from a 1031, I do. But if I can't, then we're going to look at it, But yeah, there was that was just taking that money, investing in other deals to get depreciation, interest, all the other deductions that come with real estate, and offsetting gains that way.
Got it. Now, besides investing passively in real estate, which we focused most of the discussion on, are there other year-end moves you'd recommend people make to help reduce their tax burden?
Well, first, before we move on to that, we'll talk a little bit more about active investing, because we just think that it's just going to offset our income. But I can tell you, like I had 2 new syndicators come to me this year, and their CPAs, their previous CPAs, didn't tell them that, maybe they needed to look at how their entities were set up. So these guys are making, $450,000 in acquisition fees sitting on a Schedule C. And one of them was married, one of them wasn't. Both of them got killed on self-employment tax, because the one tax that a real estate professional cannot get rid of is self-employment tax. So the one guy had a $30,000 tax bill. The other guy did as well, but his wife worked, and she paid about $25,000 into, she had about $25,000 in withholding. And so instead of also getting all of her tax back, he had to pay self-employment tax and didn't get any of hers back. So that comes from tax planning. Like they didn't have the right entity set up. You want all of your ordinary income going into an S corp, but you don't want your interest sitting in the S corp. You want it sitting in an LLC, because we don't want to run into basis issues. But any ordinary income, acquisition fees, asset management fees, construction fees, whatever's going to generate any kind of a fee, you want going into an S corp, so that we can control the self-employment tax. And what it also does is, for our real estate professionals, it gives them a W-2. So if they're trying to get a loan or refinance their homes, they show some income.
Yeah.
Because I've spent this entire year talking to mortgage brokers about, yes, this guy really makes money. It just doesn't show in his tax return.
Yeah, and that's
So,
something I'm trying to buy a house right now, and it took several calls to find a lender that would not require a tax return, because my adjusted gross income last year was zero, and that doesn't help me to get a loan at all. So back to the entity, and basically, what we've done with Four Oaks, because Deb told us, is we Four Oaks is an LLC. It's got the pass-through taxation. We've all created LLCs and elected S Corp taxation. And so my ownership into Four Oaks is through that LLC with the S Corp election, which means at the end of the year, and Deb, correct me if I'm wrong, this is how you explained it to me, so let's see if I learned it right. At the end of the year, we can kind of move the dial between what my W-2 income is from that S Corp and what my other income is from that S Corp to minimize my overall tax burden. And we're talking, difference between self-employment taxes and capital gains and everything else, right?
Right. So, I mean, we're moving money into the S Corp so that, we want to be able to take advantage of what we call the qualified business income deduction and still pay the least amount of payroll taxes. And we devised a formula to find out where that, where you'll get the maximum qualified business income deduction and pay the least amount of payroll taxes. So this is the time of the year that we're starting to look at, okay, well, you need to pay yourself a bonus, and remit the taxes so that, based on where your net income is. But we don't want, when Four Oaks has their interests, it's in their partnership, in all of their deals, they hold it just in the LLC. Because the way we do basis in a partnership versus an S Corp is different. And so, yeah. And the reason you want, when you've got partners, people, you want a partnership is so that we can specially allocate income. We are not tied to number of shares owned like we are in an S Corp. So we want to be able to differentiate, if somebody's, working more in one deal and working less in another, we can specially allocate income.
All right. And that's why I love having, a tax professional that we can refer to for all these rules. And I, as much as I mentioned at the very beginning, a lot of the education that I went through, it had nothing, it stopped where she starts as far as the LLCs and S Corps and everything else. And I'm happy that you're taking care of a lot of that for us, to be honest with you. All right. A couple other go ahead.
So some of the other things that we look at doing now is like deferring income. I have somebody that's a landscaper, so he's not doing any billing right now. He's deferring as much income as he can, and he's accelerating expenses to reduce his, so he's reducing his income. And he's actually in a C Corp. So, but we will do that with, all of our S Corps, our partnerships. If we can delay income, some employers will. If they're going to look at you, if they're paying you a bonus, maybe you can talk, we can get them to defer it until the next year. We look at accelerating any expenses we can, put them on a credit card. The credit card doesn't have to be paid to actually claim the expenses in the year that you bought them. Make sure that your 401ks, are maxed out at work if you believe in the 401ks. Certainly you want to get any free money from a 401k. So, we're harvesting losses in our, if you are holding investment accounts, but, with the way the market's been, there haven't been a lot of losses to harvest for a lot of our investors.
Yeah. So bottom line, when you're in the real estate investing arena, a lot of people will talk to attorneys about LLCs because I think there's two aspects to the entities. One aspect's the legal protection, and Deb talked about that early on, is the LLC protects you legally, from liability, but also bring in, someone like Deb to talk about the taxation part of the entities, because you may have the perfect setup, the LLC nested under an LLC with the Wyoming and Delaware and everything else that protects you legally, but you also have to look at the tax side of everything as well. And so make sure you're consulting with someone like Deb when you're, setting up your entities as well. All right, we got a lot more questions, and I'm gonna go through them. So Rachel asks, can you use hours worked through your own LLC through a real estate professional or only GP investment group active roles? So she's talking about qualifying
So I
towards.
guess it depends on what your LLC is. If she's to a real estate professional. So if you're a realtor or a broker, those hours you could count towards it. I don't know what your LLC is doing, but if it's in the real estate world, it's possible you could use those hours. You have to be more than a 5% owner to be able to do that. But it's possible, depending on what that LLC is doing.
It says real estate investing and property management. So as long as it's qualified activities.
Yeah, absolutely.
All right. Hema says she has a question. Hema, do you want to take yourself off mute, or do you want to just type it in?
Can you guys hear me?
I can hear you.
Perfect. I have terrible service. I'm at the airport, but Deb, I had a question for you. I'm getting ready to close on a joint venture, and part of my ownership stake is deriving from services. So my sweat equity. A tax professional recommended like a 83B election. I'm curious if that is something that you work in or recommend at all, or just essentially defer towards the end and hopefully have another asset that you can, in depreciation, that you can take then to offset the gains from that sweat equity.
So tell me what election he recommended again.
83B.
Oh, okay. So what the 83B election is we're actually saying, and depending on how your company agreement was set up, we should always look to the company agreement, but you're putting you put a value on that, whatever your percentage interest was at the time you got it, and you should have done that within 30 days of getting it. And so basically you might have said it was worth zero because you didn't know what it was. That locks it in, and what he's trying to do is he's turning your ordinary, because how long have you had the asset? I think he's looking at it as being ordinary income. He's trying to turn it into capital gain income by making it 83B.
She's closing soon.
Yeah, I close next week. It's not 30 days yet. It'll be 30 days, like the 22nd of December. So I'm still inside of the window.
So, I mean, for me, if, I don't typically make those 83B elections if I don't have to, because if we've held the asset over 1 year, I'm still going to look at that as being a long-term capital gain for most of my general partners. But it really, you really have to talk to him, and I'd really have to see the company agreement. Because basically when we do an 80-20 or 75-25 split, it's the same thing. These guys, they're getting that for all the work they did up front, for the risk that they took by putting their earnest money out there, because typically these are all non-recourse loans. So I wouldn't make the 83B election unless I absolutely had to. In a real estate deal, because 1061, when we're doing a tax return and we're allocating the gain is 1231. It is not capital gains. It is 1231 gains that get treated like capital gains.
No, I appreciate that feedback. I've gotten two opinions like yours, and then the original CPA was saying that I should. So it's interesting to hear that, the diversity of thought, but I appreciate that.
Sometimes I've seen it in some of the company agreements saying that you should do this within 30 days or whatever. But if you're going to hold that asset for 3 years, I wouldn't even, I wouldn't make the election. But
right.
But I mean, but I haven't read your company agreement, so I don't know what I don't know what it says in there. And the thing about that sweat equity, there's all kinds of ways for us to turn it into, you know, ordinary, capital, whatever, depending on what it says in that company agreement.
Yeah, that's something that I didn't realize as well. So take your operating agreement from your attorney and send it to your accountant as well to make sure that it's optimized for your particular tax situation as a GP. And I mean, obviously everybody in the GP is going to have a slightly different tax situation, but like make sure that your CPA is looking that over too. Good points there.
If he puts a value on that, you're paying tax right now on that. So what 83B election does is you pay tax right now. So who usually use is people with stock options, right? And as soon as they vest, like, you know, we're saying, okay, you know, I paid, you know, $2 for this option, but it might go down to zero. I mean, so you'll never get the tax back on what you pay on an 83B election, but it could save you tax in the future. But if it actually goes down in value, which real estate hopefully is not going to, that's not going to happen, but you will pay tax unless they're putting a $0 value on it. You'll pay tax in the year that you file that election.
Okay. Interesting. Now, one question from Angel, and this is referred to what hours. Similar question to what Rachel asked. You know, what type of hours count towards a real estate professional, and what kind don't? Is there a resource you can point to that gives a list of this is what you can include, this is what you can't?
You know, the list is long, and I mean, maybe I've actually got a PowerPoint presentation that I can send to Brian, and Brian can send out to the group.
Perfect.
I've got a template that, you know, Brian could send out to the group, and that'll kind of give you some ideas of the things. But, you know, talking to investors when you're visiting the properties, you're, you know, usually traveling there is not going to be, but when you're actually at a course, you know, if you're at the conference this weekend, that's going to count as, you know, education. Stuff. So, but yeah, I'll send Brian all of those templates and the PowerPoint presentation so that you have all this information.
All right, and I'll push that out to everybody on the distro list. So should be in everybody's hands in a couple of days. So speaking of distro list, most people who are here, I know I have email addresses for, and I know you probably found out about this through the email blast, but if you want a copy of that and you're unsure whether I have your email address, you know, drop your email address in the chat and we'll make sure we get that out to you. So all right, so we've been largely doing Q&A for the last several minutes. Let's open it up for another, you know, 5 or 10 minutes for general question and answer. If anybody else has any questions for Deb, and you guys can choose whether just, you know, take yourself off mute and ask, or go ahead and drop it in the chat. And if you drop it in the chat, I'll pick it up and ask her. Any other questions?
I'll go.
All right.
Hey, Deb, I know earlier you mentioned some of the C Corp, S Corp, and ordinary income. How are you normally set up? Do you guys split the portion of your income that is earned as ordinary income through the C Corp, and then everything else relates to the capital investment through the LLC? Or how do you normally arrange that?
So normally we're going to arrange an S Corp and an LLC. We're not going to have a C Corp in there. But in that S, because an S Corp is going to allow it still to pass through losses to pass down to our individual, you know, that's the S Corp is set up for. So any ordinary income, any type of ordinary income we want going to the S Corp. So, you know, if Brian's got a deal, 4 Oaks 1, the asset management fees and the acquisition fee can actually get paid directly to his S Corp. They don't have to go to his interest that's sitting in the LLC, but any distributions, you know, refinancing proceeds or whatever, we would have going to his LLC. So that's, you know, we just want ordinary income, so that distributions are not going to be taxable, refinancing stuff is not going to be taxable. But if having that LLC as the partner is going to allow us to take all of his losses against his ordinary income, because he's going to have what we call qualified non-recourse financing that gives him basis in real estate to take his losses. So in a partnership, qualified non-recourse finance is another one of the benefits of the tax code. It allows us, it gives us basis to take losses. It gives us at-risk basis as well. And that's what allows us, that's what allows all those real estate professionals to take those losses against their ordinary income. Because they've typically not put any money in, but it's qualified non-recourse gives them basis. So the interest, you know, whatever that 20% interest is, we want sitting in an LLC. We want their asset management fees, acquisition fees, any other fees they get going to an S corp.
Oh, that's awesome. And when do you actually jump to a C corp? Like, what's that breakdown for you?
And you know what? We would never hold real estate in a C corp. We would maybe only ever have income going into a C corp. But we don't really have much real estate at all in a C corp. There's some of those legacy C corps where in the really old days before pre-1986, I think, some of those C corps held apartment buildings and stuff. And so last year I worked through a deal where these, you know, this family wanted to sell this legacy apartment building. Their CPA was smart and told them they needed to sell the stock. But as you know, representing the buyer, I'm saying absolutely not. We want an asset sale, because when you buy the stock in the C corp, you don't get a step up in basis. We want to buy the asset, so we get a step up in basis. So we don't typically wouldn't use a C corp for real estate. I would stay with an S corp and an LLC.
All right. And I missed a question from Eddie, you know, quite a bit earlier. Sorry, Eddie, but he says, can the proceeds of a rental property be offset by K1 losses?
Absolutely. Yes, those are passive losses. Yeah.
Yeah. So if you have a small rental portfolio, you know, invest in and you're invested in a, you know, passively invested, K1 losses offset any gains you get. That's a fun little tool right there. Question from Jasmine. She says, as a wholesaler, not a real estate professional, what can we do in advance to help offset our capital gains?
As a wholesaler, so Jasmine, what are you holding? So is that sitting in an S corp? Is that an LLC? Like, what kind of an entity are you dealing with in as a wholesaler?
LLC, she says. And Jasmine, if you want to take yourself off mute, you can as well.
Well, so an LLC, does it, because it could be taxed, is it single member just sitting on a Schedule C on your personal tax return? It could be a partnership, or it could be an S corp. Mm-hmm. So an LLC just means limited liability company. It doesn't tell me how it's taxed. So depending on how it's taxed, I mean, if it's sitting on a Schedule C or a double. Yeah.
We sorry, gas baby in the background. But so I think my husband did an election as an S corp earlier this year. So
I'm gonna say my hearing's terrible, Jasmine.
I heard she said she did an S corp election.
S corp election. That's good. That's good. That's good. So as a wholesaler, so really your income is, you know, you have control of your self-employment tax already. But as a wholesaler, you're not really getting I mean, ask me your question again. That is not, you're not a real estate professional. Like, we can do an advanced health, but are you getting, well, no, because as a wholesaler, that's trade or business income, right? That's sitting on page 1 of what we call the tax returns, trade or business income. So are you actually getting capital gains, or are you getting ordinary income in that?
well, so I'm a W-2 employee, and we wholesale. And so really this is kind of like prepping for next year. But if we wholesaled properties, Like, that's kind of what we plan on doing. Like, is there anything that we can do to kind of prep and kind of not have to pay a ton of taxes? I mean, I don't know.
Yeah.
Because usually when you're wholesaling, I mean, are you holding inventory? You're buying them and then turning around and trying to sell them, but
It could be that we sometimes
Like a double close.
and then sometimes we've just assigned the contract. So it's
Right.
literally like it closes and we get a check.
Yeah, right. So to me, it sounds like what you're generating is ordinary income. So we need to generate ordinary expenses
Okay.
to offset that income.
Okay. So basically expenses. And I think that's what we've been doing, and it's been
Yeah.
okay.
Yeah.
Just
buy a vehicle stuff at the end of the year. Like, you need ordinary expenses
got it.
before the end of the year to actually offset that income, because it sounds like it's all ordinary.
Okay.
Now,
Right.
here's something I may not understand how things work. I mean, if you're buying and selling an asset, that falls under capital gain. So if you do a double close where you own the asset for, a couple of minutes, couple of hours, does that fall into capital gains or investment? I mean, how is it treated differently if you do a double close versus an assignment fee? That's really the question I'm getting.
Right. Even a double close, I mean, it's because it's short term and it's going to get, it's just ordinary.
Okay.
It's not going to get the preferred capital gains tax rate. It's going to be ordinary.
All ordinary. All right.
All ordinary.
All right. Any other, let's see, I'm going to scroll through to make sure I didn't miss any questions, but if anybody else has questions, now's a great time to ask or drop it in the chat.
When you're looking for a real estate specific CPA, are there some specific, like, not trick questions, but like screening questions to ask? Because I've tried to find a few, and then the deeper we get, the more I'm like, you don't really know, like, it a whole lot more than me. I'm not a tax professional by any means, but it's like what you're getting to is kind of a surface level, and I want somebody who's gone deep enough, like you seem like you definitely have, to really understand the best way to set something up and make sure you're getting the most out of your taxes.
If it was me and I was looking for a real estate CPA, I'd really want somebody that invested in it, because if they invest in it, they really understand it. And there really are a lot of us out there. But that would be my first question, because if they don't, if they don't invest, they don't, when I get a K1, I can tell that they haven't made the elections that we would have made, because they've got something in box 13K that shouldn't be there. So to me, those are people that don't really know real estate as well as they should. So I would really, I looked at a new client, and everybody they want an estimate of what it's going to be, right? So I looked at 7 partnership tax returns today from the same person. Not one of the balance sheets balanced. And that's how the tax returns got filed. Those are not the kind of CPAs you want. So the balance, they should invest in real estate. They should know how to balance a balance sheet. Yeah. But I guess for me, the number one thing would be if they were real estate investors.
Okay. So I need to, because I've done real estate. I've looked for real estate investors, but I haven't found one. And maybe you're an option. I don't know.
Yeah.
I like Emma's question, but
what?
The ones I've found are like small, like single family and stuff. And so they don't get into the multifamily level. And so I think there's a lot of details that are getting missed at this point.
And quite possibly, because even things like the qualified business income deduction. So, we took on a new client this year. She'd actually already filed her 2020 tax return, and we amended her 2020 tax return because they didn't, even though they calculated it on her S corp, they didn't put it on her personal tax return. She got an additional $6,000 back because they didn't put it on. So we're looking for all the fine details. We're always looking, and I guess, because I've been investing since 2008. For me, I'm invested in all this stuff. I want as many tax deductions as I can get, even though I can't use them annually against my ordinary income. I eventually do get to use them against my ordinary income. So, but
you never know when you're going to need them in the future. what's going to
No,
happen.
no, exactly. Yeah. So yeah, I would, when they say real estate investing, I'd ask them how many of them actually invest in multifamily in the firm. And if they say, nobody, because what I've also found at the Big Four, we've actually just hired, we've hired from Deloitte, from PwC, from KPMG, and they get so pigeonholed into doing one type of, tax that, even the Big Four don't know as much sometimes as some of the mid-level firms, because more of us are much more actively involved. And I'm doing the partnership and then taking it down to my individuals. So understanding how can I really save this person taxes? This should have never been sitting on a Schedule C. It should have been in an S corp. So, we see the whole picture.
Yeah, I like that answer. Ask them if they've invested. And I think
Yeah.
personal interests are going to come into play there, because everybody has self-interest. Everybody's trying to, minimize their own tax dollars, especially CPAs. But, if they're investing in real estate, just what I was thinking as Deb was answering that, if they're investing in real estate themselves, they've probably done the research into the tax implications of the investments and how to maximize it. So I think that's probably best answer you can have. Are you also investing? And Hema had a question. Deb, are you taking on new clients for 2022?
We do, and we do a lot of. We're in that tax planning mode right now. Like somebody's renegotiating his compensation package. Because he wants to be able to qualify as a real estate professional. So, we had a talk today about things that he could do to get rid of his W-2 that would, so and that would be for 2022. So we are doing all of that now actively. We just hired another partner who will help me in real estate. He'll be another real estate partner. We have a whole team that's, the firm does a lot of real estate. But we also I'm working on an estate tax return. I do a lot of trust tax returns. So, somebody asked me, is, having irrevocable trust, are the benefits of real estate going to pass out to the beneficiaries? And the answer is no. So I don't know, he was doing it for asset protection, but it wasn't going to pass out to him personally on his personal tax return. So it was going to save the trust taxes, but not him personally.
All right. Now, Deb, how can, if someone's interested in asking you further questions or, becoming a client, how can they get a hold of you?
Hey, well, on the a PowerPoint I'm going to send to Brian, all the contact information's on there.
Perfect.
For the
Good
firm.
enough.
Yeah. So yeah, it'll just be it's right on the PowerPoint presentation.
And the firm is McCarthy, Rose and Mills. Is that right? MRM.
Yeah, and they've been around for 55 plus years. They used to be a downtown Dallas firm, but they moved out to Frisco because it's the up and coming, part of Texas. That's where Liberty Mutual went in, Nissan and stuff like that. So it's growing for people with young kids. It's got great schools, stuff. So
And they do send out Christmas cards, which I got today, and I think that's Deb right there, all bundled up. But
we were pretending it was cold. Everybody. If you really looked at us, we're probably sweating.
It took me a while to find you because you have the beanie on and the scarf, and there's only this much of your face visible. But we got another question that got popped up right now. It's, if I use Heloc interest to fund properties and then deduct it as other interest, could that be denied by the IRS?
No, because basically my HELOC, I turned around, it's investment interest, right? It's just like when we have an apartment building and they refinance, and then all of a sudden we have to do what we call separately stated interest. It must follow the interest tracing rules, so the partnership can't deduct any refinance distributions, but individuals can, and that's just investment interest. So we deduct it as investment interest against any investment income we have. And it also carries forward. if you don't use it all. But yeah, you can definitely use your Heloc funds and deduct it.
All right. Now here's a question that I probably should have asked you 3 or 4 years ago. How complex does somebody's taxes need to be before they, graduate from TurboTax and hire it out?
I don't know, like,
Yeah.
I don't find TurboTax to be very user friendly. And if you're trying to input K1s in there, and I know it's asking
It's
you
terrible.
questions, but if you don't answer those questions right, it's hard for me to even walk through that TurboTax return. So
Yeah.
it really, and it's hard for us to even look at a TurboTax. I'll tell you, anytime we put a TurboTax return into our software, the numbers are never the same.
Right.
And a lot of that has to do with how you've answered the questions that they've asked you to determine if that number's active, passive, or, so.
Mhm.
But I'm, once you're getting, I don't know, more than 3 K1s, you might want to start looking for somebody to do your taxes, because how all that stuff fits together, elections that you might want to, and the thing is, as I said, when we're looking at your K1s, we're looking at them to say, so like, I got some K1s and these are GPs and they didn't get allocated any debt. So I'm talking to them and saying, well, you understand we cannot deduct these losses because they did not allocate you debt. And they're going, well, that's not right. And I'm going, well, you need to talk to them. So, they talk to them. They want me to talk to the CPA. I'm like, it's not my job to tell your CPA, he's got to sign the tax return. He has to feel comfortable with what he's doing. So, but he did call me and I talked to him, sent him all my research, which I also don't like doing because I spent years gathering all that research. But, he changed his mind. He amended the tax returns and my GP got to deduct his losses because he got allocated debt. So having, as Rachel said, how do you find a CPA? They need to invest in multifamily. They need to just understand the industry. And once you're getting, 2 or 3 K1s, I don't know, I'd start looking, because if you're not getting the results in your tax return that you think you should, then maybe you should have somebody look at it.
Yeah. And I told everybody at the beginning, my wonderful tax situation, I had been zeroing out my taxes for years and years and years. And this was the first year I went with Deb. So apologize if you were one of the 5 people that were on when I told this story, but I had my number. I had already zeroed out my taxes, my tax liability. And I sent everything to Deb, and I did it in TurboTax, but I sent everything to Deb, and she got me an extra $6,000 back, even after I zeroed out my liability and had every penny that I put in come back to me. So, I do have more than 3 K1s. So I think I definitely crossed that threshold in the last couple of years. If your taxes, are complicated, you got a lot of real estate, K1s specifically, definitely think about, hiring out if you're not already. But anyway, I'll send. Go ahead.
I was going to say, if I was to retire, I can tell you, I would always hire a CPA because they should be up to, and I'll hire a real estate CPA. They should be up to date. I'll just hire my old firm.
Yeah.
They should be up to date on all of the tax laws. That's what they, it's, whereas us as individuals, we don't know all the different tax laws, like all the economic stimulus payments. Did you get them? Did you not get them? Like, should you have gotten more because you had more dependents on your tax return? Maybe it was made, those are things that we are looking for when we're doing your tax return is, so.
Yeah.
So I think somebody has their hand up, Brian. He's had his hand up for a while.
Oh, I'm sorry. That's Hutch. Hutch, did you have your hand up on purpose? I see it now. All right, either he froze or I froze. There we go.
Can you hear me?
Yep.
So quick question, Deb. Great information you're passing here. So I'm looking to do a refinance and I want to roll that capital into a syndication. What is the best course of action for that?
So you're doing a refinance?
Maximize our tax advantage.
So basically, when you do a refinance, there's a calculation that we go through to determine. So basically, when you do a refinance, we're allowed to deduct all of the expenses in that year in the partnership against the refinancing
So-
money.
Hutch, I think he's refinancing his personal home.
Oh, your personal?
Yeah,
Oh, well, that's not even a taxable event, Hutch.
yeah.
No, that's not even a taxable event for personal.
Yeah.
So, yeah, you're just gonna take that money and run. You're paying a lower, I mean, you're refinancing for a lower interest rate, I'm hoping. And yeah, So yeah, just take that money and invest in a syndication.
He's in Southern California, so his property values skyrocketed over the last couple of years.
Right. Mhm.
But yeah, I'm almost kicking myself for I sold a couple investment properties, 2016, 2017, 2018, and I did invest in multifamily with it, but part of me, seeing the single family market, you always have that, you're like, gosh, man, that's what it would be worth. Anyway, well, we're oh, one more thing, Deb, this is just a little personal note. My kids thank you because it was a tax return that paid for them to go to Disney World and Universal Studios in Orlando, a month and a half ago. So if I had them all here, they would all jump up and down and say, thanks. But yeah, anyway, appreciate all that you've done. Appreciate you for taking your time to talk taxes with the group tonight. And I think we're out of questions for now, but thanks for showing up. And
Well, thank you all for showing
time
up.
with
And
us.
I'll send Brian the PowerPoint presentation and the template for a real estate professional, so you all have it.